All right. Moving on, Fortis HealthCare on their quarterly numbers. Strong quarter, as have the other companies done. Varsha is here with the segmental performance. Varsha.
Well, yes, overall a good set of numbers. If you see, there was an impact of new labour code of around 55 crore, but average revenue per bed rose over 4.5%. Onto the hospital business, wherein the revenue grew 14%, occupancy was at 67%. There was an ARPOB growth of 4.5%. EBITDA was up 28%. Onto the international patient, over here revenue grew 19%, which contributed 7.7% to the overall business. On the diagnostic business, over here revenue is up 8.3%. Good growth in margins. If you see, EBITDA margin was at 23% versus 14% last year, and they conducted 9.94 million tests. Revenue contribution from preventive portfolio increased to 12%, and contribution from specialized portfolio increased to 35% overall.
Thanks, Varsha. Well, Hiral, my colleague, spoke to Vivek Goyal, the CFO of Fortis. Hear out that conversation.
Interesting set of quarters numbers, because a good growth in terms of top line. Bottom line has been impacted on the back of two factors. If you could help us understand, with the interest expense, which has clearly seen a visible impact on the quarter's profitability, what is the strategy shift that you're looking at in terms of the next 12 to 18 months?
Yeah, so as you rightly mentioned, the operating profitability is quite good for the company. Company able to achieve 17.5% revenue growth, and for hospital business the growth is more than 19% plus if we compare with the corresponding quarter previous year. And you may see the margin improvement also for both hospital business as well as diagnostic business. Diagnostic business has also start showing very good growth. It has now start showing 7% plus growth rate. Having said that, this quarter there is a one-time impact of labor code, and this is not specific to us. This is industry-wide. In fact, all the industries are impacted which are labor heavy, and this is because of the recent change in the wage code, where the wage definition has been undergone any change, and as a result of which the actual valuation of gratuity and leave encashment has undergone a change, and the impact is coming in the P&L account. But it is a one-time type of impact. As regard interest cost is concerned, as you might be aware, last year we have consolidated the Agilus stake, where we have bought 31% stake from the private equities player by taking that, and this interest is mainly attributed to that. Plus, in the current year, we have also acquired a couple of good assets. One is in Jalandhar, we have acquired one hospital, Seaman Hospital. We have also converted, this hospital, Greater Noida, from the O&M to the lease arrangement. We have also started Manesar. Manesar is now doing quite well. And post this quarter result, we have also acquired one hospital in Bangalore. So company is in a growth phase, and if you see our leverage ratio, we are quite comfortable. Our debt EBITDA is around 1.1 time, which is quite comfortable, and the company is generating enough cash flow to serve the capital, the debt level, as well as to meet the growth aspiration.
Okay, so Vivek, tell me one thing. What is the deleveraging timeline looking like if you have to look at the next 12 to 18 months? What's that strategy?
So as such, there is no need for deleveraging, because as I said, we are in a very comfortable stage. But having said that, company, as I said, in the growth phase, we are looking for more acquisition opportunities. And as you might be aware, IHH has recently concluded its open offer. So they may also want to infuse capital. So we may like to create room in the balance sheet for our future growth. So with that, I think we will be looking for some equity infusion in the next financial year.
Okay, so would it be right to say that in the coming quarters, investors should actually narrow down their expectation when it comes to profitability growth till the time, all of these hospitals which you've either acquired or, anything in terms of expansion stabilize?
Not really, because if you see, except that Agilus acquisition, which is hardly contributing to the profitability, The Jalandhar acquisition is quite good. It is operating at 75% plus occupancy, 25% plus EBITDA margin. So it has already, meeting the interest expense by its own. And Greater Noida is the lease arrangement, so there is hardly any capital gone. So new acquisition, there is they are a sort of self-funded, and these are very good assets. And with the Fortis brand name and the Fortis operating team, we are quite confident we will be able to leverage this asset quite well.
Okay.
I don't see with the revenue growth and profitability growth, EBITDA margin improvement, if you might have seen, quarter on quarter company is increasing EBITDA, and that will definitely add to the bottom line. So interest cost from here will not go up, it will only come down.
Okay, so then with all of this said and done, the occupancy has remained stable at 67% in the third quarter. Your average revenue per occupied bed has improved to almost 2.5, 2.6 crores per annum. Now, considering the recent acquisition, when you talk about the People Tree Hospital in Bangalore, where the potential is to scale to 300 plus beds, how are you expecting the impact in terms of overall group occupancy and margins in FY27?
Yeah, so People Tree particularly, it is having one hospital which is operational hospital, and which is not functioning as per its full potential. And our first aim is to operationalize that hospital and bring it at the Fortis standard in terms of operational efficiency. And then we have also acquired the adjacent land parcel. And with that land parcel, we will be building another block there, and onco block, and then it will be a 300 bedded hospital. So it will be in two phases. And I think in first phase itself, whatever money we have paid for People Tree, the debt servicing will happen from there. And the growth part will come from the second phase.
Okay, so that's with regards to growth. Now, diagnostic margins have surged substantially this time around. Can they go up further, or do you think 23-24% is that sustainable number?
No, we feel diagnostic is a very good business, and we feel our presence, our network presence across the country, and the brand name we are carrying, there is a lot of potential in this business, and we will able to leverage that potential going forward. And there is much more to extract from the diagnostic business. 23-24 is not the optimum margin. I think diagnostic business should grow around 12-13% annually, and revenue, and EBITDA should be somewhere around 26-27%, which is in line with the competition.
Okay. In terms of individual sectors, you have renal, pulmonary, orthopedics, all of that have shown double-digit growth in the 20s. What is that next leg of improvement looking like?
Yeah, so these we have these three specialty plus onco and cardio as the main specialty, and we continue to focus on that. Onco particularly, we are strengthening our position, and it has almost become the number one specialty for us. And so is this neuro. So I think we will continue to focus on that. We will continue to invest in the technology. We will continue to strengthen our clinician base and our clinical outcome.
Okay, in terms of...
Okay, that entire conversation can be seen on all of our YouTube platforms and social media platforms as well. Now, the stage is set in the national capital as